I know I get a lot of questions. A lot of you are watching US content creators, and the US, they have these nice universal policies where they can be their own bank, and they can withdraw from their life cover at any time to fund other investment options or anything like that. Now, we don't have these policies in South Africa. We used to have them. In fact, I have one sole client that actually has a policy that he took out in the late 90s, where he has this ability. He can withdraw his life cover at any time. He can pay it back if he does choose to withdraw it. Okay, he can't top it up anymore because those facilities are not there. So we no longer have these kinds of policies in South Africa in terms of life cover where you can withdraw at any time. What is the easiest and the cheapest way to build generational wealth? That's life cover. But what is life insurance? Do you use it for property? Do you use it to protect your family? Do you recommend it? Is it good? Is it bad? And that's what we're talking about in today's video. Hi, my name is Yolanda. I'm a wealth advisor. And on this platform, I give you easy, actionable tips, content, and strategies that you can use to manage money well, live abundantly, and build generational wealth. So as a financial advisor, I'm not here to sell you a policy today, but I want to share with you a couple of the strategies that I use with my clients in order to secure them financially and build generational wealth. But what is whole of life cover? Now, I did do a comprehensive video on the differences between term and whole life. You can read more about that here. And today we're talking about whole of life cover and what it is and how we can use it in terms of building generational wealth. So what does whole of life cover means? It basically means that you as an individual, you are telling this life insurance company when you do make an application for life insurance that if something were to happen to you, you can't afford to pay for your children's education, for your spouse, and whatever bills you have if the family had to pay for it in event of your death. But you want to pass this risk, your personal risk, you want to pass it over to the insurance company, and you're willing to pay the fee that they set. Now, this fee is set on your personal risk, and the determining factors of that would be your age. Remember that a cheap life cover is always bought with young age and good health. So the younger you are, the cheaper you're going to get cover, the in better shape that you are in terms of your health, you're going to get better cover as well. We're also looking at your level of education, your level of income, the amount of time you travel on the roads, places that you travel for work, like if you're traveling into a high-risk place, that obviously affects your personal risk. Okay, so all of that will be taken into account. The company would then grant or decline to give you any cover, and a fee is set, and that fee obviously increases every year. Your benefits could increase every year as well, and also inflation is built into that to cover for the various inflation costs. So you pass on your personal risk over to this life insurance company. So you have this peace of mind of knowing that if you had to pass away, there's cash available for your family. If you were disabled, because that's an expansion of life insurance, is the full risk cover. If you're disabled, you'll still get an income depending on the level of cover you have. If you get a serious illness, you will get some lump sum payouts to help you fight this ailment that has caused you not to be able to work as before. So that's it. That's your personal risk that you're passing over to the insurance company, and that's all that life insurance is. And it's the same with your short-term insurance as well. When you take vehicle cover for your car, basically telling the company that, look, I can't afford to replace this car if I'm in a serious accident or if the car is stolen. So I want to pass this vehicle risk over to you. I'll pay you your premium, and if something were to happen, I need you to pay for it. That's all insurance is. You're passing on your risk to somebody else, and you pay a premium to have that risk covered. So how do you use this tool to start building generational wealth? Basically, you just leave a lot of money because it's so cheap, especially in South Africa. Life insurance is very cheap. You leave a lot of money to financially educated heirs, and they will use this money to build wealth for themselves, to take care of their expenses, especially if they do not earn as high as you could have if you were surviving. And they accumulate assets and live off these assets. And obviously you want it to snowball over the generations. But in South Africa, there are living benefits to life insurance that you can benefit during your lifetime. So here is the financial success framework. And I use this tool to plan for my clients. And you see at the bottom level, we have the wealth building, where you're building wealth in terms of your job. That's your active income, where you're trading your time for rands here. Okay, if you're working in your business, you're trading time for rands. If you own a business, that's your passive income, where maybe you're a silent partner or you've invested, but you're getting dividends every year or so. Rental income is another way to have your cash flow. Again, passive income, you're not actively working for that income. Okay, so that's your active income and your passive income. And obviously, when it comes to your investments that pay you, okay, that is something that I can help you set up as well. Then on the second level of that financial success framework is wealth protection, where you are protecting all your sources of wealth and cash flow. So if something happens to you, for example, if you die, obviously you won't need the cash flow at that point, but your dependents will need that cash flow to maintain their standard of living, to make sure there's food on the table, that the kids get a decent education, and if they get money, some additional money from that in order to build better wealth, then that's great as well. And we want to make sure that there's this cash flow. Also, if you get cancer, a disease where you end up in ICU, something serious, we want to make sure that there's cash coming into your household, whether you have the ability to work or not. The same if you're disabled, whether it's something temporary, if you're ill for a short period of time, or if you're permanently disabled, we want to keep that cash flow coming into your household, and that's the whole wealth protection segment. Okay, and then is the last bit on top, where we want to ensure that all of these cash flow pockets that you set up, that they're passed on in the most tax efficient way to your heirs. And we have life insurance to make sure that that happens as cheaply as possible as well when it comes to winding up your estate and passing on your wealth. And we'll get to that later on in this video. But everybody thinks that life insurance is about death. You die and a lump sum payout goes to your beneficiary, and that's not the case. In South Africa, we have some amazing products, and these are premium products. So your 1,000 Rand premium here is not going to cut it. Okay, these are high-end products with some top-notch South African companies. So there's a lot of benefits, living benefits, that you can get from your life cover. And the first one is a retirement, where you have the ability to draw from your life cover to fund you during your retirement, and that withdrawal is tax-free. That's a very sweet benefit to have. Okay, when I sit and do calculations with my clients, we find that the lump sum withdrawal from the life cover actually exceeds their retirement annuity income that they would get from the retirement annuities. And that is such a big difference. And remember, that's tax-free money. You never have to pay tax on this, because you don't pay tax on life cover products in South Africa. The second living benefit of life insurance in South Africa is, one, you don't have to pay premiums when you retire. Certain companies, certain products allow for your premiums to be paused at age 65 when you retire, but you continue to have full benefits in place, your full life, your full risk benefits in place. Okay, again, this is premium cover. Okay, not everybody offers it, so you got to be with the right company to get these nice benefits. And if you speak to people that are retired, and you'll find one of the most biggest component of their budget, their expense, is one, medical aid. You can't really get away from that one. And two, it's the life insurance. And so this is a major expense that you don't have to carry into your retirement. Okay, and a lot of the times we always talk about expanding our wealth and building our wealth, but rarely do we look at actually conserving what we actually have. And this is one tool, that just one segment in this one tool, that allows you to do it. So combine that with the first one of withdrawing from your life cover. That is a very sweet retirement just waiting for you right there. The next living benefit of life cover is the ability to get cash payouts in times of illness. So when you retire, obviously a little bit older, okay, and then these diseases come about, maybe a mild stroke, a mild heart attack. At that point, your life cover is going to pay you in your illness, in your downtime, because you'll need these extra funds to get back on your feet. Again, a premium product, not all companies offer it. Secondly, you get cash payouts from your life cover at various life stages. For example, at retirement, we were actually doing a case study in the office recently, and we found that a client is going to get back over R1 million I think it's almost 3 million rand that he'll be getting back when he retires at age 65. All right, this is something separate from his lump sum life cover payout, and something separate from the regular withdrawal that you can make. All right, additional tax-free money at retirement coming from your life cover. And it doesn't just happen at retirement, it happens younger as well. For example, when I turn 40, I'll get a sweet payout when I turn 40, so I can celebrate in style. So that's something that I'm looking forward to as I age. Okay, so those are the living benefits, but you do have some additional add-on benefits that you can add to your life cover to make sure that the beneficiaries will be able to better utilize what you've left there. For example, the education add-on, and numerous companies in South Africa offer this, where you add this education add-on that allows your kids to be funded up to age 24 or till the first degree, whichever happens sooner. So basically, if you pass away, instead of your family using this lump sum life cover that you've allocated to them to fund your children's education, maybe you have 2 or 3 kids, I mean, that can add up, and overseas study even more so. Whereas the education benefit will automatically take over the education costs separate from the lump sum. Okay, so obviously now this lump sum is going to last you a lot longer, especially if you're not paying for education for your kids from there. And education inflation is at 8-9% in South Africa, higher than regular inflation. So when you pass away, the education add-on will take care of all your kids' needs, from tuitions to extracurricular up till university level. Overseas studies included as well. Obviously, there's terms and conditions and there's slight variations with the various product providers, but there's a very handy benefit to have. And even if you don't pass away, a significant amount of tuition fees will be paid for your children. Again, all providers are a little bit different, various terms of conditions. You can speak to your financial advisor about the various products available on that. Another handy benefit to have is the medical aid benefit, and how that works is if you're to pass away, instead of your family paying for medical aid expenses from your lump sum provision, the medical aid add-on will now pay those premiums for you. Another very handy benefit to have, especially since medical aid increases can be horrendous every year. Your 2,000 Rand premium this year can easily be 8,000-9,000 Rand in 10-15 years time. Okay, and that's the benefit that's going to cover the full cost, or even up to 75% of the cost as that progresses. So that's 2 heavy expenses of education and healthcare that does not have to come from your lump sum benefit. One thing that I find that I'm recommending to more of my clients these days is, as opposed to leaving a lump sum payout, I recommend more of my clients to leave income. Let's say you leave a 10 million Rand lump sum to your spouse when you pass away, and you're expecting your spouse to settle whatever debt there is, the bond, the cars, credit cards, all of that. Put some money away to take care of the spouse and the kids for the next couple of years, and then invest the rest to fund the kids' education, possibly business, weddings, that kind of thing, as life goes on, right? What happens is, if this money ends up in somebody's hands and they're not financially educated, that money can literally disappear, wasted on cars, on parties, on frivolous material stuff. Okay, if you leave life income, so meaning, let's say you get 40,000 Rand a month. Let's say you leave 40,000 Rand a month every month, adjusting for inflation every year for the next 10 years, until your youngest turns 24, until the first degree, until your spouse passes away. You have that flexibility to do that. So this ensures that there's a continuous supply of cash flow coming into your household despite. So ideally, you should be educating your family on how to handle these funds. And 2, when that cash income comes every month, there's no risk of them running out of money, especially with people that do not know how to handle large sums of money. And what I usually find is it's traditionally much cheaper to leave life income, monthly income, as opposed to a lump sum. When we do the calculations, we find that sometimes that 40,000 Rand a month equals to greater than the planned lump sum amount that you are hoping to leave. Okay, so you're getting a lot more for less of a premium when you select monthly income life payouts instead of a lump sum. And also, if you receive that lump sum, and assuming your family is going to invest that money and live off that in the form of annuities. Annuities are taxed in South Africa. Okay, your family is going to have to pay tax on that money. Whereas with life income payouts, there's no tax. It's a straight 40, straight 50, whatever it is you choose to leave for your family, that money comes in and that money is tax free. So the question begs itself again, why aren't more South Africans using cheap life insurance that is in South Africa to build wealth for themselves in their lifetime and for their families when they are no longer here? I know I get a lot of questions. A lot of you are watching US content creators, and the US, they have these nice universal policies where they can be their own bank and they can withdraw from their life cover at any time to fund other investment options or anything like that. Now, we don't have these policies in South Africa. We used to have them. In fact, I have one sole client that actually has a policy that he took out in the late 90s where he has this ability. He can withdraw his life cover at any time. He can pay it back if he does choose to withdraw it. Okay, he can't top it up anymore because those facilities are not there. So we no longer have these kinds of policies in South Africa in terms of life cover where you can withdraw at any time. You do have the other living benefits that I mentioned as well. So when you ask me about these cash value policies, what you're actually talking about is financial velocity. And by financial velocity, it means that you want to leverage one pot of money, okay, where you have it as in form of security, but you want to take it out and you want that money to work harder for you. But you can't do it. You can't necessarily do it on a universal policy unless you already have a universal policy. Okay, but you can do it in the form of securities-based lending in South Africa. That basically means you're investing with an asset manager. Let's say you invest 300,000, 400,000, eventually it's 8,000, 800,000, maybe R1,000,000. But that asset manager now allows you to borrow against that. So you're borrowing against the security. So you can take this money out, put it in a quick investment, flip it. Each asset manager or financial services provider will have different rules when it comes to the securities-based lending. So some, they let you borrow for a period of 2 years, some a couple of months. But essentially why you want to leverage securities-based lending is because you're not triggering capital gains tax. For example, if you had R1,000,000 in your investment portfolio and your financial services provider provided you the service of securities-based lending, not everybody does this. Obviously, these are premium products, right? So instead of you selling off 500,000 worth of investments to get into your next deal, something very unique, you can borrow against that. Okay, take out 500,000, not trigger any capital gains tax. Do your quick deal, make your quick profit, and then pay it back. Okay, so that's a very, very sweet deal to have. Now, the rules vary across providers. I work with quite a few of them. So if you want to get in touch with me and start leveraging that way, whereas you don't have the universal policies anymore, you can do that and click the link where you're watching this video and we can chat one-on-one to set that up for you. The bottom line is you got to be using financial velocity to earn and to make money in multiple places using the same rand. And securities-based lending allows you to do that. And basically that's the dream, right? And if you're able to do that, that's it. You're a financial genius. So this is a legit thing. Not many people know about securities-based lending. Obviously, you got to have a sizable portfolios to start leveraging this. But these are very real things available to all South Africans. So if you want to start investing and start leveraging securities-based lending, you want to start enjoying living benefits of your life cover instead of your family just enjoying all of that money when you die, reach out. I can set you up with these premium products with premium investment companies, and you can really enjoy the benefits of some really nice financial services products in South Africa.